First and foremost, we sit within in a world of investment that is growing. So the demand for decarbonisation, for moving towards lower carbon environments, is stronger than it's ever been. So the UK government has been very vocal on its support for that, which helps. But really, the mega trend would be there, I think, regardless of government support that can come in cycles.
Hello, you're watching Proactive. I'm joined by Edward Mountney. He's director of Foresight Group and one of the co-lead managers of Foresight Environmental Infrastructure. Ed, very good to speak with you. For viewers not familiar with the fund, tell us more about FGEN and your objectives.
Yeah, thanks, Stephen. For those that don't know FGEN is a diversified environmental infrastructure fund. What that means is we invest across numerous technologies, so not just wind and solar, but we've got various different assets that we put together to create a complementary profile of individual assets. That includes renewable energy generation assets like wind, solar, anaerobic digestion, and that's really the bedrock of the portfolio. But then we've also got assets in other energy infrastructure, so things that don't generate electricity or heat, but still contribute towards decarbonisation and still sit within energy markets, and things like batteries and low carbon transportation. And then we've also got another category of sustainable resource management investments. So that's again things that sit outside energy markets completely and offer really good diversification, but still play a vital role towards the decarbonisation of the UK.
So take us through your investment proposition, Ed.
So investing in FGEN, like I said a moment ago, gives access to a wide variety of assets which are otherwise hard to invest in individually for retail investors. Those assets typically come with mature, stable technologies and deliver stable returns and predictable income opportunities. Predictable income and also opportunities for growth. We also recognise that investing in environmental infrastructure is one of the most significant investment megatrends of this generation, and a differentiated offering provides diversification and risk reduction. We have a resilient and attractive return profile. We have 11 years of uninterrupted dividend growth and a high quality manager in Foresight Group with over 40 years of investment experience. And then lastly, we've also got a robust governance framework with a fully independent board that provides strong manager oversight.
Just looking at that dividend growth, Ed, you're right with your results this week. You've increased the dividend targets again, offering a 10% yield. What gives you the confidence this level of income can be sustained in the years ahead?
Well, you're right, Stephen. We're really proud of that track record of increasing the dividend. So that's now the 11th consecutive dividend that we've proposed. And the dividend per share for next year is a target of 7.96p, which, as you point out, is a yield of 10% on the current share price. We think that offers really attractive return for investors from an income perspective. Now, we at Foresight have got a good degree of understanding of these assets. As I mentioned before, we've got 40 years of experience in investing. And we can see from the cash flows that are coming out of our projects that we are more than comfortable in sustaining that dividend, even under downside scenarios. So we had a record cash distributions coming out of the portfolio last year. That gave us a dividend cover of 1.32 times, which was the second highest we've had since IPO. And even under those downside scenarios where power prices were to drop catastrophically, we'd still be able to cover the dividend in the near term. So that allows us to make really well-informed investment decisions and also capital allocation decisions such as increasing the dividend.
You've been through a strategic review, and as part of that, you plan to shift towards core inflation-linked assets. How will that impact near-term returns and growth prospects?
So you're right. We have conducted a recent strategic review of opportunities. That was really a board-led decision. The manager contributed towards that, but it was board-led, so independent from that respect. It included both a qualitative and quantitative set of analysis. And the conclusion was that a refined investment strategy was the best way forwards. So we have set out several investments that we particularly like the looks of, but really what we're trying to do is illustrate the sorts of assets rather than the characteristics that those assets have. So we're less focused on which technology they sit in, whether it's anaerobic digestion, whether it's wind, whether it's solar, and more about what can those assets contribute to a diversified platform. So what we really like is long-term, stable, inflation-linked contracts, because we know that if we add those to the portfolio, that will enhance the visibility that we've got over revenues, and again allow us to make informed capital allocation decisions, as well as make decisions around how we can extend the lives of our assets.
Can you explain your plans to divest growth-oriented assets? What criteria will you use to decide when and how to sell these projects?
So in recent years gone by, we've added about 15% of the portfolio in what we've labeled as growth assets. So for us, that's really three investments. So we've got CNG Fuels, which is a low carbon transportation business that specializes in CNG, or compressed natural gas biomethane. So that is a platform of 16 operational refueling stations across the UK that has clients along the lines of Amazon, Royal Mail, John Lewis Partnership, and so on. So that investment's been doing really well for us, except it still requires a bit further ramp up in order to get to the sort of scale that we think it can get to, where it will deliver the best possible return and value for shareholders. So that's a similar story to two other growth assets that we've got. So we've got Project Rjukan, which is a recirculating aquaculture facility in Norway, and we've also got a co-located glasshouse in the portfolio as well. So these are all earlier stage investments that we think have got really exciting growth potential, but require 2 to 3 years of ramp up time just to demonstrate what we think that they're capable of doing. And then we think at that point in time, selling those assets to a strategic investor or an investor with very deep pockets, we hope, will generate maximum return for shareholders.
Ed, you've returned over £24 million through buybacks so far. What role will buybacks play going forward, and how do you weigh this against new investments?
So buybacks have been an important feature of FGEN for a year or so now. We set out originally with a 20 million buyback program. That was increased not too long ago to 30 million, and I think we've returned about 25 of that to shareholders so far. So buybacks, as well as reducing gearing, have been two of the fundamental strategies for FGEN over the last financial year, and we think we're delivering well on those. There is a role for buybacks that will continue so long as the discount persists. However, we really see it as an opportunity to invest in our own portfolio. We, as the manager, we believe in our NAV, and the sorts of returns that you can get on our portfolio at the discounts that you've got, for us, are simply too good to pass up. So on the one hand, people see buybacks as an opportunity to narrow the discount. We're less convinced of the merits of that, and we prefer it really as an investment opportunity.
Given persistent macroeconomic headwinds and lower NAV per share, are you managing risks to maintain resilience and protect shareholder value?
So we do that in a number of ways. I suppose the first thing to point out is, at its most basic level, we want to maximise the value that we're getting out of the assets that we have under management. So that's demonstrated by the record cash flows that we've seen coming off the portfolio, and it's had 10 years in a row now since IPO of increasing those cash flows year on year, getting more out of the projects than we did the previous year. So that is protecting the dividend, protecting the dividend cover and the income that we're providing to shareholders. But then on top of that, we recognise that in the current market, actually it's important to provide capital growth opportunities in excess of the income. And that's really where these three growth assets come in. And if you think about what we've got in the book, so we've got 15% of these growth assets. That means we've got 85% in income generating assets, and that's providing the dividend cover of 1.32 times. So 85% of the book covering the dividend 1.32 times. We think that's a really strong message, so that the capital growth assets can really be the icing on the cake if they progress as well as we think they will.
Any tailwinds that are taking you through 2025?
Absolutely. I feel like there's plenty of tailwinds at the moment. So first and foremost, we sit within in a world of investment that is growing. So the demand for decarbonisation, for moving towards lower carbon environments, is stronger than it's ever been. So the UK government has been very vocal on its support for that, which helps. But really, the mega trend would be there, I think, regardless of government support that can come in cycles. But then on top of that, we've also got several changes which have, I think, narrowed the discount for FGEN and also pointed towards a resurgence of the popularity of investment companies. And that's the area that we're really excited by, and we hope will continue on into the second half of this year.
Ed, I hope you'll continue to keep us updated on your progress. Thank you very much for the introduction today.
Been a pleasure. Thanks for having me, Stephen.
Edward Mountney is director at Foresight Group and one of the co-lead managers of Foresight Environmental Infrastructure.